All right, let's dive into a question that pretty much every investor in India asks at some point. Should I go with an ETF or a mutual fund? It's a huge decision, and as we look ahead to 2026, figuring this out is more important than ever. So we're going to break it all down for you. So you've done the hard part, right? You've saved up some money, but now you're at a crossroads. Where do you put it to work? This choice between ETFs and mutual funds can seem really complicated, but I promise by the end of this, it's going to be a whole lot clearer.
Okay, before we pit them against each other, let's just lay a quick foundation. It's important to remember they're both designed to help you build wealth. They just take slightly different roads to get there. Let's start with what they actually are.
First up, the good old mutual fund. The easiest way to think about this is like a big investment potluck. You and thousands of other people all chip in a little bit of money, and a professional fund manager takes that giant pool of cash and buys a whole bunch of different investments. It's the classic way to get diversified fast.
And then we have the ETF, which stands for Exchange Traded Fund. Now, just like a mutual fund, it's a basket of different assets. But the absolute game changer is right there in the name, Exchange Traded. This means you can buy and sell it throughout the day on a stock exchange, just like you would a share of any big company.
So here's the key takeaway for now. At their heart, ETFs and mutual funds are trying to do the same basic job, give you a diversified basket of investments. They can both be used to track the big market indexes, like the Nifty 50 or the Sensex, so you don't have to go out and buy hundreds of different stocks one by one.
All right, now that we've got the basics down, it's time for the main event. We're going to unpack the 5 critical differences that you absolutely need to understand to choose the right one for your portfolio in 2026.
Let's kick things off with difference number 1. And honestly, for a lot of us, this is the big one, cost. Because every single rupee you spend on fees is a rupee that's not growing for you. So how do they compare?
And wow, this chart really tells the story, doesn't it? The data for 2026 shows the median ETF has an expense ratio of just 0.56%. Compare that to 0.90% for a mutual fund. Now, I know that might not sound like a huge gap, but trust me, over 10, 20, or 30 years of investing, that small difference can add up to tens of thousands or even lakhs of rupees.
So you're probably asking, okay, why are ETFs cheaper? Well, it really boils down to how they're built. The vast majority of ETFs are passively managed. They're not trying to be clever, they're just on autopilot, tracking an index. That's way cheaper than paying a whole team of analysts to pick stocks. Plus, they have fewer admin costs and usually no sales commissions, or loads, which you often find with mutual funds.
All right, let's move on to our second key difference, how you actually buy and sell these things. This might sound like a minor detail, but it says a lot about how flexible they are.
This slide lays it out perfectly. With an ETF, you're trading all day long, just like you would a stock. The price is always moving, and you can get in or out whenever the market is open. Mutual funds, totally different story. You place your order, and that trade only happens once per day at a price that's calculated after the market closes. That price is called the net asset value, or NAV. So ETFs have a huge advantage when it comes to flexibility.
Next up, difference number 3. And this is a big one that people often miss, but it can seriously impact how much money you actually get to keep. Let's talk about taxes.
Just look at these numbers from 2024. It's kind of shocking. A whopping 64% of mutual funds passed on taxable capital gains to their investors. Compare that to just 9% for active ETFs. What this means is, with a mutual fund, you can get hit with a surprise tax bill at year-end, even if you never sold a single unit yourself.
So what's the secret sauce behind this tax advantage? It all comes down to how they handle big buy and sell orders. ETFs have this clever process where they can basically swap shares of the ETF directly for the underlying stocks with big institutions. It's a trade, not a sale, so it doesn't trigger a tax event for the fund. Mutual funds, on the other hand, often have to physically sell stocks to raise cash for investors who are cashing out. When they sell for a profit, well, that taxable gain gets passed on to all the investors who are still in the fund.
All right, on to number 4. This one is super simple but incredibly powerful. It's all about knowing exactly what you own.
I mean, this is a night and day difference. ETFs offer you almost total transparency. They are required to show you exactly what stocks they hold every single day. You always know what you're invested in. With mutual funds, you're often waiting a month or sometimes even a whole quarter to see what's actually under the hood.
And that brings us to our 5th and final key difference. This one gets to the very core philosophy of the investment itself, how it's actually managed.
You see, most ETFs are what we call passive.
They have a simple goal: just match the performance of an index, like the Nifty 50. No heroics, no trying to outsmart the market, just slow and steady wins the race. Most mutual funds, though, are active. This means you have a fund manager in the driver's seat, trying to pick winning stocks to beat the market. And while that sounds great, it means higher fees and, frankly, a pretty high risk that they won't succeed. The data shows most active managers actually fail to beat their index over the long run.
Okay, so we've laid it all out there, the 5 big differences. But now comes the most important question. What does all of this mean for you? How do you actually make a choice? Think of this slide as your personal decision-making guide for 2026. You should probably lean towards ETFs if your top priorities are keeping costs as low as possible, having the flexibility to trade anytime, and being super tax efficient, which, by the way, usually means you need a Demat account. On the other hand, mutual funds might be the better fit if you really believe an expert manager can beat the market. Or, and this is a big one, if you love the discipline of a systematic investment plan, a SIP. The mutual fund system is just perfectly designed to make those regular, automated investments incredibly easy.
And really, that's what this all boils down to. There's no secret best investment that's right for everybody. It's not about which one is better in a vacuum. It's about which one is better for you, for your financial goals, your comfort with risk, and your own personal style of investing.
So there you have it. You now have the essential knowledge to choose between these 2 powerful ways to invest. The question is no longer, what's the difference? The question is, which one is right for my portfolio in 2026? Use what you've learned today to take that next confident step on your investment journey. Thanks for joining me.